Good morning. This is Jim Colburn with Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is January 14th. Good morning, Andy.
Good morning, Jim, and Happy New Year to you and all our listeners. We haven't done an energy markets blog between the two of us in a while. So let's get at it. There's been a lot going on in the oil market since our last podcast.
Yeah, I feel like it's already January 14th. This time is flying. Andy, why don't we start out with the OPEC meeting? Saudi Arabia cutting back 1 million barrels a day for February and March. I mean, that's just summarize what that's all about.
Well, yeah, that was obviously a very big surprise to the market. You remember, Jim, we were going into that meeting with Russia talking about wanting to increase production by another 500,000 barrel a day in February and March after the 500,000 barrel a day increase in January. Kazakhstan also talking about an increase, and there had been, Iraq, UAE, Kuwait, all have been jonesing really to increase production. So the market was really going into this OPEC meeting expecting an increase in production coming at the same time that it had expected that demand in the first quarter was going to soften. So, as I said, it was really a great diplomatic move by the Saudis saying, you know what, we are going to cut production by 1 million barrels a day, thereby allowing a slight increase to Russia and Kazakhstan. And we believe, looking at the supply-demand balances, that prices should stay relatively steady, which may, which may prevent increases in the rest of the group. So it really was a great move by the Saudis, and the market took it that way, rallying very sharply because it was totally, really unexpected. And I think what it's done is it's added some discipline to the group. Certainly, seeing Saudi taking a hit for you is probably not going to give you incentive to increase production right now. And also it takes out some of the loss in demand. Saudi's trying to match production with demand, which brings up another major point here, how well really OPEC Plus has done over the last 6 months, really, since the price war, 6 to 9 months, Jim, in trying to manage the market. You have to give them kudos. I mean, they've really done a good job.
After they totally messed up,
right?
Early, March and April of last year. They're doing well now, yes. And the EIA, so the Saudis are trying to manage this supply demand thing going forward, and the EIA came out with their short-term energy outlook on Tuesday, and this is something we talked about right from the get-go, is that it's all about the virus.
Yeah, the difficulty that producers certainly and refiners are going to have and have had in second half 20 and certainly all through 2021 as we look ahead is trying to figure out, where demand is going to be. are certainly right now in first quarter with growing lockdowns, and we've already seen I'll talk about that later on U.S. gasoline demand, but certainly first quarter 2021 is going to be very difficult. And then as we move into second quarter and third quarter, obviously demand that will be very well correlated with economic activity, which will be correlated with how quickly the vaccine is distributed, and how quickly how quickly we can grow the service sector, jobs, travel, all in a big in a big unknown. And it may be, you look at where these demand estimates are, and you look at the difference, say, just with OPEC and the EIA, they're millions of barrels apart, millions of barrels a day apart. I look at doing my own balances, and which I used to do the balances a few times a quarter. Now, Jim, I'm doing them like almost daily, trying to figure out where these demand numbers are.
Well, I was saying that to you earlier today. The EIA has a forecast of $53 for Brent, I guess, starting in they said from the second quarter of this year on through the end of 2022. So it's almost like throwing up their hands and saying, we have no idea. So let's just go with this price forever and ever.
Right. So what they did, they took the spot price, right?
Yeah.
And took it out and say, all right, it's just going to be 53 through 22.
Yeah, I think they said
through 22.
Yeah. This is their first shot at 2022. I thought, you get an estimate like that. What they don't publish is a standard deviation around that.
Right. Right.
I'm going to write an article on getting tripped up on standard deviation. It's unbelievable. It's one of the first statistics you learn in the statistics 101 is the standard deviation, and people just everywhere kind of get tripped on it. So including political polls. But anyway,
was that the Brent price or the TI price?
I believe that was Brent.
Brent. All right.
Brent. Yeah.
You know what? If the EIA is right, I think the Saudis and OPEC Plus would be delirious, because 53 would be a good price for them, because it really, the revenues will be okay, certainly better than last year, and it will discourage. It should discourage a lot of growth in, at least from the shale producers. It works for shale producers, but it's not going to really, move the needle like, say, 500,000 barrels a day or 1 million barrels a day. That's probably 53 is probably a couple of 100,000 barrels a day in growth. So, if that would be a big win if that number is right. But I think both of us know something.
Yeah. Well,
as does the rest of the market, right?
Yeah, you want to sell a $53 straddle as far as out as you can based on the EIA's projected price.
Right.
And I'm not putting down them as analysts. I think they're great, but it's just the world we live in right now.
Right. I think they do a fantastic job also. It's really difficult to predict price, and all we have to do is look at 2020, right? I don't think anyone, if anybody said that they saw oil trading negative in 2020, at the end of 2019, they're basically full of it.
Well, it's as we were youngsters back in the 80s, I kind of fell in love with this options market. And one of the reasons was early on, I think it was 1989, when we had prices were around $14. We had a very successful OPEC meeting. They agreed on cutting back and quota systems, stuff like that. And the price rallied over 10% out of the meeting, absolute small number. And volatility got crushed, and there was one trader I think it was on the floor, that blew out because volatility imploded. And we said, it's usually the other way around. It's usually people sell vol, they sell strangles, and for months and months, and then the market blows up and they blow up. So it's kind of like, wow, this thing is different. And then Gulf War One, we had that was a crazy time. And you said these oil markets are, you thought you saw it all, and then this year, I characterize it as the year that people were paying money for the right to sell something for nothing. And I said, I never thought I'd see that happen, but like you said, negative prices will do that. So it's been an incredible 2020. We don't expect the same for 2021. And before we get into the details, I just want to talk about these monthly. We look at the big three, as you call them, the EIA, the IEA, and OPEC. And OPEC released their monthly oil report today. But the EIA also shows their changes from last month, and it gets kind of confusing because if you look at their inventory, these would be the changes from last month's estimates. They bumped up inventories 1.5% for, I assume, at the end of 2020. And for 2021, they bumped up their ending inventories at 1+1.4%. So all the changes that they made in supply and demand, turns out the inventory is going up. So that number by itself should be you would think would be a bearish report because you're looking at the changes from last month. However, it does show inventories going down and demand going up. So the report, so it's kind of like, okay, yes, they've increased inventories, but we're in this crazy situation that they're just trying to catch up to the numbers. And so how are you reading the let's just take the report overall, the EIA report. How are you looking at that as sort of new information to the market, and what does it mean for prices? And then we'll dig down into some of the details.
I was reading the report yesterday or 2 days ago when the market was was unexpectedly up $1. And a reporter called me and he said, what's going on? And I said, well, I happen to be reading the short-term energy outlook right now, and I'll tell you what, I wouldn't be buying it based on the STEO. I mean, it wasn't overtly bearish or bullish. I think what you take away from the market, from the EIA numbers, if we looked at it on a macro, just take the very big picture on stocks, on global stocks. They have a fairly, they saw global stocks drawing pretty rapidly in second half of 2020 and also into the first quarter of 2021 over 2 million barrels a day each quarter. But then they see that stock draw moderating. The second quarter only down like 500,000, and then second half they actually have stocks like unchanged. So I think what it definitely does help to explain some of the certainly a lot of the recovery we've seen in price if stocks did actually draw that much in the second half. My numbers aren't quite that big, Jim.
Mm-hmm.
Our numbers, the CRG numbers, aren't quite that big, but the OPEC 2 is showing a draw. The OPEC oil market report, which came out today, also showing a pretty good draw in second half and also into first half 2021. And that's actually what that's what we're moving on. Right, that's why the market has come back this strongly, because of that that Saudi output cut has now, at least for the first quarter, has shown us has at least is one would expect, or analysts like myself are expecting, a bigger draw than we had, obviously, than we had into December. The other thing you read, and we could talk about this on the details of the EIA report, at least, the one thing people really are laser focused on this EIA report is U.S. crude production.
Right.
I'd say out of any number in this report, that in the EIA short-term energy outlook, that is always the bold headline,
Yeah,
right?
yes, reported. Yep.
That's the one where, the reporters are, EIA says U.S. production is going to do this, in 2021 or 20, that's, so to me, that's the first number that I always look at.
Let's
And
let's kind of make it the second number we look at. Let's just take a look following through with OPEC production and your balances. What are you working with, say, past the first quarter? I mean, once they cut back 1 million and then another 1 million in Feb and March, what do you see for the rest of the year? And I know it's depends on the vaccine and GDP, but what's your expectations for the OPEC production?
yeah, this is one of the major unknowns in the market, where they're, how they're going to increase production as the year goes, as the year unfolds. First quarter right now, OPEC production, they just came out with OPEC came out with their number, and the fourth quarter, well, it was 25.3 is the was the December number, and the fourth quarter number came out to be, it was 24.9 for October, November, and December, but that comes up with a lower, October number was low, and November and December they've been increasing production. In first quarter, I have a net increase from fourth quarter of 200, because they're increasing by 500, and we are going to get some added barrels probably out of Libya. And then in second and third quarter, one would expect that they're going to start unwinding this production agreement, assuming prices remain here in the 50s, and I see OPEC production going up into the by third quarter up by 1.2 million barrels a day, and then a little bit more into the fourth quarter. But Jim, that's all unknown. That's, that obviously adds a lot of uncertainty, as much as they want to try to manage the market. But the uncertainty on the production side, pales at the uncertainty on the demand side.
Right.
And I'm showing, my numbers, I'm showing roughly 1 million barrels a day growth each quarter in 2021, which is, it's close to where the EIA and the OPEC numbers are. And I have draws, Jim. I have draws all year.
Right.
So, we're looking for stocks to draw by, I have an average of around 800 to 900,000 barrels a day for the whole year.
Yeah,
Which is, that's constructive, but
yes.
the thing is, it could easily be off by 1 million barrels a day anywhere, and
Right.
I think that's the challenge for OPEC.
Yeah, it's I guess they're going to be following demand, and yet they have this excess supply that it's probably the biggest. I guess 2020 was big, but 2021 they'll have plenty of excess supply to lay on the market should it start getting a little frothy, I would guess.
Yeah, I think they're I think they've got 5 million barrels a day in reserve, which is pretty high for OPEC.
Right.
So yeah, I mean, you can get production increases from the Saudis, UAE, Iraq. They all have spare capacity. And on the non-OPEC side, certainly, we'll see where, how long Russia is going to want to stay where they're at, because remember, they've cut back by over 1 million barrels a day.
Right.
So, they've more or less, they've been close to where they're supposed to be producing. They're over what their quote is, but how we don't know, what price is it going to take for those barrels to come out, and whether or not, whether they still want to, how the OPEC Plus alliance wants to play out, because again, the Saudis took the hit here,
right?
So
Um,
they'll have some leverage going forward.
and their next, you said their next meeting is in March or April?
Yeah, the next meeting is March.
And that's what is that, a technical meeting?
That is, yeah, I think it's a technical meeting. I mean, they're basically setting strategy for the next, quarter.
Yeah.
So
it's amazing how their meetings have evolved since the old days where they was just hush, 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 and then they go into the ministerial meeting and come out with something. And now, they I don't know, they talk to the press. I guess there's, they lay the groundwork. It's, it's pretty, it's almost like the Fed. They have the Fed governors going around making speeches, and you get all these clues, and then they come out with the meeting, and they've done a great job, I think.
Well, this last meeting was, was a complete surprise.
Complete surprise. That's true.
Yeah. They didn't. That cut wasn't in the trial balloons that they usually try to put out. And I think the market was discounting, as I said earlier. The market was discounting an increase.
Right.
It came out with a decrease.
Right.
So and we came up with a nice rally.
And that affected the curve as well, right? I mean, it's been moving up.
It's been moving up. It didn't shoot up. It's been moving up anyway. But I think some of that's the hedging activity in the back of the curve.
Right.
Which is, again, getting back to the U.S. production numbers, and that fits into the whole, to the non-OPEC story. How U.S. production, the EIA has us basically flat here for many months. Right now, according to the last weeklies, we're at 11 million barrels a day.
Right.
And they have us in 2021 basically right around 11 million barrels a day until fourth quarter. And even then, they only have us increasing by a couple of 100,000. I don't think that's right.
Yeah.
I think production's going to be higher than that.
Yeah, I see the number 11.1 for the whole year. So that's
right.
Yeah. Right. What are you coming out with?
I think it's going to be close. And that 11.1, right? And that gets November. They have 11.3. In December they have 11.3 also. So I mean that's where the real growth is. I think it's going to be close. I think it's going to be closer to 11.2 or maybe even 11.3. OPEC has 11.4 in this last report, but they've been higher than what the EIA has been. Jim, we're getting a lot of there's been a lot of preaching out of the shale producers about their discipline and capital constraints.
Right.
Maybe that's so. Maybe that's so. But I'm sure that that we could see the hedging activity in the back of the curve, which now we see 2021 over $50. So
I don't know if you remember, we have talked over our careers. We talked to many oil producers, and they would describe themselves, if you lock them in a room with, turn the lights out, no stimulus at all, they just start getting more bullish.
Right.
That's just their nature.
It's their nature. And certainly, they have not. They certainly have been, they haven't been a great investment, for years here. But maybe there will be some capital constraints, but certainly there are capital constraints. But certainly, we see the rig count has increased significantly from the August lows. DUCs have come off. Costs continue to come down, making break-evens lower. So I think 100, at least 100 a day more than what the EIA has here is Could even
Yeah,
be conservative, Jim. I don't know. I don't know.
yeah. I mean, I think the EIA is talking about the production curves. They're pretty steep.
Right,
You
right. The
know,
depletion curves. Right.
depletion. Yeah, so that
Yeah.
offsets. Even if you get more rigs out there, it's not going to be enough to offset the declines. So that
Right.
I think that's where they're coming from. But
Right. But we're also going to see growth in offshore. Certainly this spring and fall, we'll see growth offshore, assuming that we're not going to have hurricanes with Greek letters, next year. Because we lost a lot of production in, during hurricane season.
right.
In July, we were producing almost 11 million barrels a day. At the height of hurricane season in October, we were down to 10.4, and now we've recovered to 11.
So why don't we kind of do you want to say anything else more about U.S. oil production?
No, I think we've covered that.
Yeah. So why don't we talk about demand and what are you looking at? Again, we've talked about the uncertainty, but well, let's why don't we just talk about where you see oil demand going over the next year? You have a
Well,
gradual. You said gradual increase.
yeah, I have. Yeah, a gradual increase. It could be, maybe it'll be more than a gradual increase, or
Yeah,
less. Again, a
yeah,
lot of that because the loss in demand for last year was, transport fuels.
right.
Diesel hung in there because the manufacturing sector has been so strong. So diesel demand last year was, I don't know, I think it ended up being uh, unchanged, a little bit higher in the U.S. Globally, probably a little bit lower, but it wasn't horrendous. I mean, the big losses were gasoline and jet fuel, and their recovery is based on how quickly we can, it's going to be based on how quickly the vaccine is distributed.
Yeah,
I think jet's going to take a while, Jim.
yeah. It's a good. You know, I have to say, I live in New York, and I was just able to sign up for a vaccine appointment, which is March 3rd. And I'm thinking, think of that old Seinfeld episode where he tries to rent a car. They know how to make the reservations. They don't know how to keep the reservations. So I'm not confident that I'm going to get back a vaccine then. But if I do, and I get the second one, I'm going to be. I got some pent up demand to do some traveling.
Right?
So
Yeah, we
yeah.
all
So,
do.
but I kind of have to wait for my wife. So it's kind of like it's not going to be like a switch going off. It's going to, I don't think. I mean, it's going to be more like a rolling thunder. I don't know. So
Yeah, it's hard to predict.
it's going to happen. I think it's going to
Yeah,
happen.
it's going to happen. But are we going to get back to, pre 2019 levels? Well, the EIA says we won't.
Right.
And or does OPEC until
Right.
2022.
Right.
And I think that's probably right. I mean, we're business travel. Yeah, there's certainly a lot of pent up demand, but is behavior going to change?
You're right.
Uh,
Definitely, it will. Yes.
it will, right? I
Yeah.
mean, and
We've gutted out so many, hospitality type jobs that there's a major hole in our economy that has to be sort of addressed, that leads us to all this infrastructure spending or just spending in general. That's we used to worry about billions of dollars. Now we're up to trillions, and it's not a problem so
well,
far.
yeah, and that's another factor. How will the this fiscal stimulus that's definitely coming, or if I shouldn't say definite, right? that
I think, yeah, I think everybody's a Keynesian now.
right, everyone's a Keynesian, but how will that, how will this new stimulus package, affect petroleum demand? It should help,
Yeah,
right? But we certainly need jobs. I mean, that's a key component for gasoline.
right.
Um,
Gasoline, but the cracks have been doing well. I don't get that. And
yeah, that's been a hard one to explain. that the cracks, I think, particularly the diesel cracks, one thing that's really worrying about this market is distillate. Stocks have built by 15, U.S. stocks have built by 15 million barrels over the last 3 weeks. We're not in horrendous shape on distillate, but we're 10 million now over the 5-year average, and days supply are like 3.5 over the 5-year average. So, but yet, the cracks have been have hung in there.
Yeah.
They've rallied. Gasoline cracks too have rallied, and I think, the main, I think what's happened, and that refiners have really kept runs well below year ago levels. They've exercised some incredible discipline on their crude runs because margins were crummy, and now margins are increasing. So we'll see. And runs are beginning to creep up. Gasoline production is beginning to increase. So we'll see. But
haven't some of the refineries been mothballed?
Yeah. Refineries have been mothballed,
and that's just not in the U.S. That's around the world.
Globally, globally. But we're still getting refinery capacity is probably. They're being these, what's happening is we're seeing some of these old inefficient plants here in the U.S. and in Europe be replaced by new capacity in Asia that are way more efficient, and the diesel machines really, and petrochemical machines. That's another story altogether. Is petrochemical demand. Right. Last year was pretty good, and I think next year is going to be, continue to be pretty strong. Got some new, there's some new petchem plants in China that's replaced some of these, really, mid 20th century, maybe even earlier, 20th century refineries, here in the U.S.
Well, the process of distilling has been around a long time. That's for sure. It's not always for oil, but anyway. So the bottom line that I'm getting from listening to you, and the bottom line that I'm getting from the EIA, and I haven't looked at OPEC yet, is that even though we have a vaccine, it's starting to roll out. We are facing increasing cases, but again, the bottom line is tremendous uncertainty ahead as to when demand starts picking up and we come out of this.
Right. And, where are we, looking at global stocks, again, as I mentioned, how quickly are we going to draw them? We built earlier in this year, we probably built close to 1 billion barrels of global stocks, and we're slowly but surely drawing them off, but we still probably have 400 or 500 million excess. Maybe it's less. That's the thing with these numbers. You don't know. But I think you're right, Jim. The big story is where we don't. We're trying to anticipate where this demand is going to go. Is going to be. It's going to be a moving target, and it may be difficult or maybe it won't be. They've done all right so far for OPEC to try to manage going forward.
I'll just throw in some option stuff here. It's almost like I'm not getting really good clues as to what's going on or what people are thinking in general. Just maybe the last couple of days on into these rallies, starting to see more open interest gains in the puts than the calls, but not a big way. We've had volumes over 100,000, not so much yesterday, but it has gotten over 100,000, which has become, it's a good, it's not dead, but I wouldn't say the market's going crazy. Seen a little bit of spread options trade. The April, May, June plus 50 calls. Those are kind of like, I think they're kind of like lottery tickets for these things, and people buying those, looking for obviously more backwardation. and people selling them probably saying no way. I think if I had to coax something out of you, you might would rather be on the sell side of those, Andy.
Yeah.
In terms of backwardation, you don't see backwardation in April, May, June getting up to plus 50.
Well, of course, anything's possible, but
Anything's possible.
I don't. At least first quarter, I think crude stocks are going to grow here. So, I don't see a big backwardation though.
Yeah, and the biggest CSO spread option is the April minus 50 put with 29,000 open interest, but those traded a while ago. So again, I'm not, I don't want to spend much time on this. Implied vol for the second month is around 32, 33%, which is the long-term average. And that's what happens when the market rallies. We see vols come in, the market more imbalanced. And I think it's too early, to see any kind of option play ahead of these OPEC meetings in, March and April. Maybe we'll keep an eye on those, because sometimes you see an option that's not allied for a meeting get crushed in vol, and the one behind it gets bid up, but not seeing that at all. But yeah, so vols are down around their long-term average. That's about it.
Well, I guess it's not surprising that vols moved, came off, as you said, the markets rallied.
Yeah.
I mean, we have a lot of uncertainty ahead on these, as we've mentioned on where we're going on both sides, on supply and demand. But, it doesn't seem like there is, that uncertainty is so great that it could lead to the market, really coming off hard. That at this point, looking at these balances, I don't see like a real market unraveling,
Right.
unless Russia comes out and say we want to go back to, we want our 1,000,000 barrels a day, but it doesn't seem like they will, because the strategy has worked.
Right. So, Andy, last question for you that I have is, there's started seeing a press about talk about a commodity super cycle, and speaking of Russia, is it Kondrakev? I forget the guy's name. His wave theory that they're looking at the commodities haven't done well. GDP is way over where commodity indexes are on a historical basis. What do you think of those kind of arguments that we're in some kind of we're entering a super cycle?
Jim, you know what? I think we've gotten caught on this one before, right? on the super cycle, and I guess and we've certainly, over the last 3 or 4 years, we've certainly been looking for the inflation,
Right.
and that hasn't happened. Although certainly metals have had have had a major rally. I mean, you look at just our part of the world. You look at petroleum, and because there's still spare capacity, within OPEC, and certainly here in the U.S., we can ramp it. We certainly have shown that we're able to ramp it up, and going forward into the 2020s. The demand outlook is certainly uncertain as we head into the second half of the decade. So I'm not sure petroleum is going to participate in a super cycle. You, Jim? What do you think?
I agree. It's I think each individual commodity has its own fundamentals. There could be some kind of, I mean, obviously economic activity has a lot to do with their correlations. My feeling is, if you think the dollar is going to be weak, why would you buy commodities? Why not sell the dollar? So I don't,
Right.
but when they do correlate, it's usually some third factor that's going on. So yeah, I agree. I think there are reasons. There are sort of macro reasons, and then there's individual stories. And I think oil's got a little bit of both, as you say, and that excess OPEC capacity would have me, if you're getting a rally, if you're bullish, you play it, you get the market go up. I'd say, there's a OPEC's going to release some oil at the next meeting, so be careful. That's all.
Right. That's exactly.
Yeah.
I mean, yeah.
So basically, I could see the market moving up. I'm not looking for some kind of super blast.
No, something would have to, there'd have to be the geopolitical upset or,
right.
So something like that. And certainly, if you've looked at the history of petroleum, that's certainly definitely a possibility.
Yes.
Andy, and who knows later in the year, as Iran starts grabbing the headlines, we'll see what happens there. But I think that's for another podcast, Jim.
Do you want to make a couple quick comments on the Biden administration, the energy transition, what it means for oil? Or do you want to hold that off till next month?
I think why don't we hold that off till next month? We'll have some clear, we'll have something clearer from the Biden administration. As I was trying to allude to, I think obviously this Iran nuclear deal is going to be moving to the forefront, as we head into 2021. And certainly there's going to be a lot of green elements to the Biden administration's view. But let's not forget that some of the biggest increases in crude oil production ever came under the Obama-Biden administration.
Of course.
So,
yeah. And if you think about, if I just throw at you infrastructure, do you in your head, do you vision all these wonderful, beautiful lit up bridges, or do you think of the big dig in Boston? Billions of dollars across overruns. So yeah, we'll take it step by step, Andy.
We'll take it step by step, but I think a lot of the infrastructure spending is probably going to move towards more, carbon capture type stuff,
right?
And greener stuff than oil drilling,
yes.
Which we need. We need it, right?
We do need it. Very good, Andy Lebow. Anything else? I'm going to sign off.
No, if you have any questions, you feel free to get a hold of me at Lebow, Alebow, at commodityresearchgroup.com. Go to our website, commodityresearchgroup.com. Jim posts a couple of times a week on the blog, and that's always interesting. And we will see you next month.
Great. Thanks, Andy, very much.